Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
Welcome, everybody, to another episode of the Bigger Cash Flow podcast. Today here I have Mel Batkis from Ross Diversified Insurance Services. And Mel has been in the insurance services industry for over 32 years. And today I have him on the show to talk about rental property insurance. Welcome to the show, Mel.
Thank you, Bo. Nice to meet everybody.
Yeah. So, Mel, I wanted to put you on this podcast to talk to our investors about the different types of coverages and what investors should be aware of when providing coverage for their rental property. So, can you tell me a little bit more about yourself and what kind of services RDIS offers?
Sure, be happy to. Thank you. Ross Diversified Insurance Services, we're a national insurance agency that works with about 200 lending institutions and about 1,000 investors throughout the United States. We're a national agency located here in Southern California. My brother and I are partners in Ross Diversified. We started in 1986, so we used to be young like Bo, and now we're the old guys on the block. Primarily, we are on both sides of this aisle here. We not only are insurance guys, but we're real estate investors as well. What we did when we developed the program that Bo and I are going to speak about today is we try to put ourselves in the shoes of an investor ourselves, where we go out and if we're in Memphis or we're in Indiana or wherever we might choose to look geographically in the country, what do we need to protect ourselves? And so my brother and I approached the risk secure product with what is the best protection for an OLT, which is owner, landlord, tenant type of policy that we could actually provide. And we're real focused because we're older guys on the liability component. We want to make sure we have protection. We want to make sure the chips that we have, that we keep them. We spend a lot of years to earn our money, and we don't want to give it back on anything silly or foolish with not paying attention to a liability claim. If you live in Southern California and you own your home in Southern California and you have your insurance with Allstate or Farmers or State Farm, and you buy an investment property that you're local in your local community within maybe an hour away, it's very easy to have that same local agent service your needs, and they probably would do a very good job. However, if you're in Southern California and buy a property in Memphis, that same Farmers or State Farm or Allstate agent can't really help you with your insurance needs. So what we try to do is be the local insurance agent for investors investing in purchasing properties nationwide, and we do provide insurance in all 50 states.
That's awesome. So for the benefit of our listeners, I wanted to frame this conversation around specifically residential rental real estate, 1 to 4 units. And I wanted to talk about the fundamentals. So let's talk about actual cash value, ACV, versus replacement cost. I know it's a hot topic among investors in the forums and mastermind groups. I just want to debunk any myths and explain clearly what the differences between the two are and what is generally recommended.
Great question. And first off, replacement cost means the replacement cost of the structure. You have different marketplaces, and there's different costs to replace a certain structure in one market versus another. For example, in California, if I'm taking a very basic ginger box type of home, you're looking at $150 to almost $200 a square foot for replacement cost of that home in Southern California. That same home in Middle America, Memphis or Indiana, that same replacement cost is closer to anywhere from $75 to $100 a square foot. What Ross Diversified did when we were doing this again for our own investments and our own research is we were looking at a lot of different turnkey providers and what they provided. And we found that when a turnkey provider goes into a home, they're usually using, one step level above a Home Depot. And I'm not putting anything down on Home Depot. It's just if you have a custom home that you're living in, you might want to put Toto toilets in and marble counters and things like that. But if you're in a investment where you're maybe invested, we'll just call it for number's sake $100,000, and you have $1,000 rent, that tenant in there is not going to have marble counters. You're going to supply it with basically a Home Depot type of material. Where there's different prices throughout the country, we found that $75, $80 a square foot seems to be the sweet spot. Now, you might have a house that's a little fixed up a little bit more or one a little bit less, and you can vary it based on that. The misnomer is a lot of times people think, well, I'll just buy more insurance, and if it burns down, then I'll have more insurance to rebuild it. And that's not true. What happens in an insurance claim is you're only going to be paid if you have the replacement cost for what that replacement cost is. So, for example, if I have a home here in Malibu sitting on a cliff that I buy for $10 million and, I put a $5 million loan on it and I want to put $5 million of insurance on it, if it's 1,000 square foot at $100 a square foot and it burns down, the insurance agent's only going to pay me what the replacement cost of that structure is. So it really doesn't matter how much insurance I place on it, it's going to have to correspond to the replacement cost. Now, whether you're Allstate or Farmers or State Farm or us, most insurance companies use national appraisers across the country, and they have what is known as a software package called Marshall, Swift and Beck, which is kind of like the Blue Book, the Kelly Blue Book of homes. And it'll go in and it'll say, okay, these homes were built in 1971, and what are the improvements in these homes? And they will put those numbers into their model, and that'll spit out a number. And yes, there might be a little bit of arm wrestling here and there, but for the most part, they're pretty accurate, and they're going to know what the replacement cost of that, 800 square foot house in Indiana is going to cost. Now, if that home has got improvements in it, and you're buying a turnkey product from a turnkey provider that has been recently rehabbed, then you want to have the documentation. You want to show what justifies the value of that home for that replacement cost. Replacement cost is paid if you rebuild. If you do not rebuild, just like your own homeowner's insurance, then it reverts to an actual cash value. Actual cash value means a depreciation. So, for example, most homes have a lifespan between 50 to 70 years. And they'll take that home and they'll depreciate. So, for example, we've seen areas, for example, Oakland, California here. In California is an area where there's a lot of homes that are 70, 80 years old. And you'll see a policy that might have $100,000 insurance replacement cost, but if they don't rebuild, they depreciate that, and you might have $10,000 or $15,000 actual cash value because they're depreciating that number. So if you don't rebuild, the policy only pays actual cash, even if it says replacement costs on it. You have to rebuild to get replacement costs. Now, there are some policies out there that are actual cash value no matter what. For example, California Fair Plan writes a lot of policies here in California, and in certain areas they'll only write actual cash value. If you're up in a fire area like Lake Arrowhead, and there's certain areas where they have certain restrictions, and sometimes they'll only write an actual cash value. Some of our competitors out there write actual cash value policies only. So it doesn't matter what the value you're going to request for insurance coverage, you're going to have that actual cash value depreciation factor. If the house is brand spanking new and it was built in 2018, 2019, and it burns down, actual cash value and replacement cost are the exact same number. So that's kind of a big picture between actual cash value and replacement cost. Again, the key is to document the property that you have a picture, you have portfolios, you have receipts of all the work that was done on the property and when that was done.
Okay, let's talk about an example for our investors. Typically, investors are buying homes either turnkey, which mean they're fully rehabbed, or they're buying a distressed property and putting in a new flooring, some paint, maybe new appliances, a new roof, some CapEx items. So you mentioned documenting these items. what would happen if you had a actual cash value policy compared to a replacement cost for like a 1970s home that was newly renovated? Would there be a big difference there?
No, as long as you can show the item is, for example, flooring. What you have to know is in a rehab, there's certain bones to the house that you're not redoing. If you totally knock it down and build it from scratch, then what I said earlier about replacement cost and actual cash value being the same, that's a valid statement. Where the gray comes in is, what was your rehab? A lot of people come in and I call it ginger box it up. They're going to put in some new flooring, they're going to paint, they're going to maybe put in some window coverings, and so they're maybe bought a house, a distressed property for $50,000 or $60,000. They put 10, 15 grand into it. They rehab it. It looks really nice. They're either going to put it on the market, allow our rehabbers, and sell it, or they're going to hold for long term and rent it out. So just because you splashed a little bit of money into it doesn't mean it's a brand new house. There's a big difference, and that can vary depending on, I've seen rehabs. I know I've done it myself in my own home where, you could spend hundreds of thousands of dollars doing a rehab. Then you're really talking apples to apples when you talk brand new. But if it's just a splash and it's just some items, know what you're putting in. When it comes to a claim, and the most important thing when it comes to claims is, number one, to make sure you have an accurate date of where the occurrence of the claim happened. It's pretty easy in a fire claim because there's a fire report. The fireman came out there. He knows that it happened on this date. It's public record. This is where the fire was. In the case of a fire, you want to make sure you have as much documentation to the state that your rehab was in or your property was in. So that adjuster who comes out there with his Marshall Swift-Beck software to adjust the claim, well, if you have someone meet him at the property, not the tenant usually, your property manager or yourself, with the narrative of what you really did here, and a portfolio of pictures speak louder than anything, and it makes it real easy for that adjuster to adjust that claim very fairly. And unlike what a lot of people think, most adjusters are paid more money the higher the claim is, but they need to justify it, and they pay attention to the rules of the policy. Otherwise, they're not going to be an adjuster for much longer. But the point that I'm getting at is you want to have someone who meets the adjuster at the property, has as much documentation to show what state the property was in at the time of the loss. Now, a fire claim is real easy. Where it gets a little murkier and a little grayer are vandalism and malicious mischief claims, and I know Bo's going to get into coverages in a little bit. But there you want to know when the occurrence actually happened, and you want to document that, especially if you have a vacant property and you're working on it and you're rehabbing it. You want to make sure that you have as many inspections and pictures at each inspection of the work that you're doing on the property, and you want to, if it's a vandalism claim, you want to make sure you file a police report and you have all the documentation to make the adjuster's job as easy as possible so that everybody can win when it comes to a claim settlement.
That's really good to know, because I think one of the fears that I had was, insurance is great and it's another form of defense when it comes to asset protection. But once it gets to the claim, if I don't have the right support or documentation, the claim could be denied. Was there anything that you wanted to add to that?
Just, that you want to be honest with your adjuster. I've seen this just recently, so that's maybe why I bring it up. But, adjusters have a lot of access to a lot of data, with Google pictures and things like that. And I recently had someone who complained about a water leak on a roof, and they put the claim in, and the adjuster's claim came back and they denied the claim, and they said it was previous damage. And the investor kind of got a little upset and says, wait a minute, this just happened. And so I went back to the claims department and I asked for some support and some documentation, and they showed me that they had Google pictures of where there was a tarp over the roof, several months prior, right in the exact same spot where there's a roof leak. And it was just kind of like, oh my goodness, this is kind of embarrassing here, because they really do have support. So they will know if there has been claims filed. They have databases to find out if, okay, there's been these kind of claims that have been filed on this property. They can go back and they can say, okay, there was a storm on such and such a date. There was a tarp on the roof prior to that date. So I guess what I'm trying to say is, there's some wiggle room here and there, and you want to put your best foot forward when you're presenting your narrative. But the claims adjusters are pretty bright. They know how to be FBI agents. They know how to talk to neighbors. They know how to find things out. So, not to sound like what my mom and dad would tell me, but honesty is always the best policy.
That's exactly right. Okay, so let's get into coverages. There have been a lot of questions that I get when trying to determine how much coverage is actually needed and what type of coverage. If you can speak to us a little bit about type of coverages and also about how premiums are calculated.
It's a great question, Bo, and kind of like what I started when I first started to present. What Ross tried to do is be that local agent in that local community on a nationwide basis. And in order to do that, it's got to be zip code rated. Now, it does get down to math 101. First off, the first component of it is like we just talked about. It's the math of how many square feet you have and then your cost per square foot. And so once that math is taken care of, and let's just keep the numbers easy, let's call it a 1,000 square foot house at $100 a square foot. I know I need $100,000 worth of coverage. That's the basic math. And again, we can talk a little bit about differences. Do I need $90 worth of square footage of replacement cost, or do I need 110? And it can vary. The rate also is based on zip code. It's all zip code rated. So if someone, and we chatted a little bit earlier, where I had a customer who bought a couple of homes in Florida, and we quoted them, and the rates are a little higher in Florida. They're actually a lot higher in Florida because of the wind risk and the hail risk, and wind and hail are part of every one of our policies, and it's a lot higher risk when you're in any of the Gulf states for wind and hail. But there's also flood insurance, which we do sell flood insurance. We write all our flood insurance to the National Flood Insurance Program, so it doesn't matter if it goes to Allstate or Farmers or whoever, but flood insurance rates are rising rapidly, and that's the government program where someone can buy a house and they had flood insurance at $3,000 or $4,000 annual policy. The new owner can buy it, and those rates automatically raise, and sometimes they're double and triple. And yes, triple. I had one where it was like a $100,000 house, and it came back at like an $8,000 premium.
Wow.
And the investor was like, what's going on here? And we're saying, well, this is the government. Doesn't matter if it's Ross or Farmers or Allstate. That's the NFIP policy, and you're a block away from the beach, and they're raising all the rates, and that's when they raise it, is when the ownership changes from the National Flood Insurance Program. So in answer to your big question here, is rates vary based on the zip code. We have higher rates when there's a higher risk for wind and hail and those type of damages. But the basic math should be fairly close, other than the geographics being, the cost per square foot for replacement cost.
I was talking to another investor, and he mentioned that depending on the insurance company, they might look at the number of claims in a given city. For example, I invest in Kansas City versus Indianapolis and Little Rock. Does that play a factor? Like if there is maybe 1,000 claims in Kansas City one month and there's only 20 in Indianapolis, does that factor into the underwriting play as well?
For our carrier at this point in time, it doesn't. We have had a few clients where the frequency of claims are high, and the insurance company will look at investor A and say, geez, this investor has had 7 properties with us and he's had 21 claims, and they'll say, we just don't want to insure their properties. So we have had those type of situations. The insurance policy is not a policy for you to do improvements and rehab and fix that property up on the insurance company's dime. Do some investors get away with certain parts more than others? Maybe so. And so insurance companies will look at that. But primarily what we're looking at here is weather is the big factor in the geographical area. It's not really claim sensitive. And what we do with our policies, where we really stick out our chest with a lot of pride in, we haven't really talked about it yet, but is the liability component. As an investor, you want to make sure that you're protected in case someone slips and falls and sues you. Whether you're an LLC, a private individual, and I'm not an attorney, I don't want to give that type of advice, but you want to make sure that you're protected the best you can. Every single one of our policies is an individual policy per property. and each policy has $1 million worth of liability insurance and a $2 million aggregate, meaning that if I had a claim for $1 million in one calendar year, I could have another $1 million at the end of $2 million. You've exhausted the liability coverage for that property. But if you have 10 different properties with us, then you have 10 separate $1 million liability policies with $2 million aggregates. One has nothing to do with the other. So if you have a claim on 123 Elm Street and then you have a claim on 125 Elm Street, the claims have nothing to do with each other. Again, if you're a frequency and you're constantly filing claims and, if they're fire claims and there's a fire report, it's pretty obvious. But, again, we've had some investors that will use the policies is to try and rehab the property, and the insurance companies, they get savvy to that. But all of our policies are individual policies per property, and each one has its own $1 million of liability coverage on that property.
And is that a minimum that you guys generally recommend? What is a good limit? I've seen $500,000, $1 million, $2 million.
I'm real comfortable. I've seen $300,000 liability limits. I've seen $500,000 liability limits. At $500,000, I'd probably be comfortable. Each one of our policies are $1 million. I think that's just a nice number. But at the same note, I've been doing this for 30 plus years, and the liability claims that I've seen come through the door have been $50,000, $60,000, $70,000. Maybe a tree falls on someone. There's been some slip and falls and things like that. So most of the liability claims I've seen have been less than $100,000. So I don't want to sound like I'm talking on both sides. Maybe just my experience wants me to have $1 million. I sleep better with it. And that's the number that every one of our policies has $1 million on it. But if you have $500,000 on it, I wouldn't stress. If you have 300,000, you might want to talk to whoever your carrier is and see if you can bump it up to $500,000. That I think should be a sweet spot.
Okay. Sounds good. So let's kind of segue into deductibles. I know there's also a lot of talk about deductibles, how high should your deductible be, and what the thought process is when kind of determining an amount. I personally like $2,500 because that's the amount I'm comfortable with covering out of pocket. Anything above that, I believe it's to be like a bigger CapEx issue that I would generally feel like I would file a claim on if it's a really big $10,000, issue. So can you kind of talk to us about deductibles and how that plays a factor into the premiums?
Absolutely, and it is a direct cost. I mean, the higher the deductible, the lower the premium. That math part is fairly consistent. Bo, you and I have talked about this before, and I'm an investor too. And that $2,500, we provide three options with each one of our quotes: $2,500, $5,000, and $7,500. The difference in the premium dollar amount isn't that drastic. If you want to have a custom deductible higher, let's say you have a couple hundred properties and you feel very comfortable with wanting to outlay a $10,000 or a $25,000 deductible, I've seen certain investors who want to do that, but you're really talking when you have several hundred policies, and it's a different type of risk strategy. Where I feel, in myself personally, is that $2,500. You're not calling in what I don't want to call them, but the nuisance claims. If you can have someone come out and repair something for $200 or $300, a handyman, that seems to take away those nuisance claims. They're done usually within a 24-hour period, and you're not dealing with the time of filing a claim. Although we advocate file a claim whenever you want to file a claim. We don't ever want to hinder anybody in filing a claim or try and convince them not to. But the $2,500 seems to be that sweet spot, and it's really just kind of taking care of the nuisance type of claims and keeping your premiums as reasonable as possible.
And, when it comes to coverages, I noticed that my property managers would like me to put them as an additional insured. As an investor, I talk to many other people who either start off by putting properties in their personal name and moving it into an LLC, or start off by putting their properties in an LLC. Is there a limit on how many property managers or LLCs you can put in as an additional insured? And is there an extra fee to this?
Good question. And yes, you want to include your property manager on your liability. But I'm going to make a point here that the liability policies do not protect you when you're employing workers to work on the property. For example, a lot of rehabbers will come in and they will have the liability, which if someone comes on the property, slips and falls and gets hurt, then they're covered. But if they're having a worker do work on that premise, the liability excludes that. Those are workman's comp, and you want to make sure your contractor has that. Now, some people use unlicensed contractors and hire their own laborers. Do they do that? Yeah, but you're taking that risk. So the liability, I just want to make sure that distinction is there. As far as property managers, they're absolutely part of that policy. They should be listed on every single one. There's no limit. There's no extra fee to add them on as a loss payable additional insured on the liability component.
And what's the thought behind putting your PM as an additional insured? And an additional question to that is, let's say my PM also does repair work for me. So if they have a roofer come out on my behalf and there is, a slip and fall, an accident, then would I not be covered in that example?
No, if that roofer falls, then you're not covered. That roofer needs to have his own insurance. If the property manager is hiring people to do work on your property, then that worker has to be licensed, bonded, and have their own insurance. Do they do it and just have someone come and repair it? That's a risk you're taking, but no, it's not covered. The property manager in showing the property and doing his duties as a property manager is covered, but he's not covered as a repairman on your property.
Gotcha. And in regards to LLCs, if I were to transfer a property to an LLC, would that LLC still be extended the same coverage if I add them as an additional insured?
Yeah, it's no problem for us to work with LLCs, partners, and I'm not an attorney. I'm not going to give legal advice when it comes to how you want to structure your investments. And I've heard all the different seminars on Wyoming companies and Nevada companies. And again, I'm not an attorney. I'm just an insurance guy who's saying that it's no problem for us. However, one of the caveats is that when you're doing loans, and we've talked to a lot of people who do loans on single family investments, sometimes when you're doing the loan and you're applying for the loan, and I'm not a banker as well here, but I just want to make sure that you're aware that we notify your lender if you make any changes to that policy. So if Bo buys a property and then changes it to BK Properties and wants BK Properties listed on that policy, we have no problem doing that endorsement. There's no charges, there's no fees. We do it with no problem at all, but we do copy your lender on that change. So sometimes you have a note under Bo and then you change it to BK Properties. You change the name and then your lender says, wait a minute, who's this new entity? And so it might have some repercussions when it comes to calling your note. Most lenders don't, but again, I'm not giving that type of advice. I'm just letting you know that if you do make those changes, we are required to let the lender know of those changes. If you own it free and clear, then it really doesn't matter.
Awesome. What are some regular maintenance items that investors can do to make sure that they take care of their property and a coverage isn't delayed? I mean, one thing that I hear often is if you have a property that is in a colder part of the country during the winter, make sure it's winterized if it's vacant. Are there any tips and tricks that you'd like to share with our listeners?
Well, one of the tips that I just learned from a seminar that I went to a conference was one of the turnkey providers was telling me that, because we have to winterize the property, but we want to show the property because we're trying to rent it right away, so we don't want to shut off all the water. So what we do is we keep hot water running through the pipes, and that stops the pipes from cracking from winter. So that was a tip I had never heard before with all these years. And he says, yeah, we just keep the water going through it, at a dribble, hot water, and it keeps all the pipes running. And this way we have no problems when we're trying to rent that property out. You have to do maintenance on your property. You have to maintain your property because a claim that, it's always, a claim is always what caused the damage. It's always a cause and effect. So if what caused the damage was some deferred maintenance, then that deferred maintenance can cause your claim to be denied. I, for example, it bothered me because this is Northern California, a property that I own, and the drain it's a fourplex between the property and the sewer on the street was getting clogged up. And the reason for the clog was because I had these big trees on the property, and the tree roots were getting into the drain. And so the insurance company said, no, Mel, you got to cut those roots out. So then I went to the city and said, I want to cut this tree down, and it's Northern California, and you can't cut the tree down because it's Northern California. I won't say any more. I won't get political with this conversation here, but I ended up having to replace the drains and then cutting those roots to try and make that tree, but I can't get a permit to cut the tree down, so I'm kind of caught. But those tree roots are my problem. It's a deferred maintenance type of thing. And if you know, in this property, I've actually done some rehab to it too as well. I had some cracks in a sidewalk, and I knew the cracks were there. You know, the insurance company didn't know I knew, but I knew. So I had a responsibility. I didn't want my tenant to fall in the cracks. So what I did is I had the property manager hire a crew to jackhammer the walkways and then put a nice little gravel that was all even so that I could take care of the problem right away, decide if I want to do something cosmetically later on or not. But the point is if you know there's a problem with your property and your property manager knows, then you have a duty to fix it. Just because you're not telling the insurance company, that's those adjusters that come by, you know, that they kind of know what they're doing. So they talk to neighbors. They're kind of FBI agents specifically. They can look at pictures and they can see things on a property. So you just want to make sure you take care of your property. Like, you know, the golden rule again, take care of all your stuff.
Wow. This was a lot of really good stuff, and I'm sure I'm gonna have to have you back on the show to share more of this and more, I guess, advanced strategies and insights into the world of insurance. But, you know, before we wrap up, is there anything else that you'd like to share with our listeners?
You know, I think that we're in a day and age where interest rates are low. Again, as I said at the very beginning of this podcast, is I do believe in real estate investing. So we're on both sides of this. Just look at your property. I think if there's one bit of advice that my experience can tell me is share with you, is that you want to know the property before you purchase it. It might cost you a little more money to fly to a location that you've never been, but if you're going to invest money in that location, you might want to just be there. And again, this is age, experience, whatever you want to call it. But if you're at a property that you're thinking about buying and you see it at 10 o'clock in the morning, it wouldn't be the worst thing in the world to drive there at 10 o'clock at night and sit in your car for 15, 20 minutes and just get a feel, a vibe of the neighborhood. That's about the one thing that my age and experience I'll share is you want to know what you're buying before you buy it. And so do your homework.
Yeah, that's some words of wisdom from an investor himself. And it was a pleasure having you on the show, Mel. Where can our listeners reach out and find more about your services?
Well, we're on the web. It's www.rossdiv.com for Ross Diversified. You can always reach us at our office here, 1-800-210-7677. Again, that's 1-800-210-7677. And I'm always available on my cell phone, as Bo would tell you. I know a lot of people work during the week and they don't have time to call other than nights or weekends, and I'm totally okay with that. My cell phone number is a working cell at 714 area code 697-2457. Again, 714-697-2457. Don't call real late at night or you'll have to talk to my wife. Other than that, I'm available 7 days a week.
Awesome. Thank you so much. And I'll have all that information on the show notes. And thanks for listening to this week's episode. If you have any questions, feel free to reach out to me at bo@biggercashflow.com. Thanks, everyone. Thank you for listening to the Bigger Cash Flow podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.